In this chapter, we are going to look at the measurement of property, plant, and equipment. Initial measurement: once an item of property, plant, equipment qualifies for recognition as an asset, it will initially be recognized at the cost. So the standard gives list of the cost component. These are the purchase price less any trade discount or rebate, import duties and non-refundable tax, directly attributable cost for bringing the asset to working condition for its intended use. These are the cost of site preparation, the cost of installation and testing cost, professional fees, and delivering and handling cost. Initial estimate of unavoidable cost. It means the cost that we could not avoid, such as dismantling and removing the asset and restoring the asset on which is located. However, income and related expenses of operating that are incidental to the construction or development of an item of property, plant, equipment should be recognized in profit or loss. According to the IS 16, the following costs will not be tolerated to be part of an item of property, plant, equipment. These costs are administration and other general overhead costs, startup and similar pre-production costs, initial operating loss before the asset reach planned performance, expense out in the profit or loss rather than being part of the property, plant, equipment. So the subsequent measurement, the standard offers two accounting models, essentially a choice between keeping the an asset recorded at cost or reevaluating into the fair value. So these two models are the cost model. An entity might carry the asset at its cost, less depreciation and any accumulated impairment losses. On the other hand, reevaluation model, an entity may carry the asset at reevaluated amount, being its fair value at the date of reevaluation less any subsequent depreciation or any subsequent accumulated impairment loss. An entity should revalue its asset with sufficient regularity so that carrying amount does not differ materially from the fair value of at the end of the reporting period. Importantly, if an item of property, plant, equipment to which that asset belongs shall be reevaluated, and the change of the assets carrying amount as a result of reevaluation should be treated in the following ways. So I'm going to explain the way that it will be the asset should be increase or decrease, and scenarios that as a result of reevaluation and the end of each financial year. So when you carry out or conduct reevaluation, the result of reevaluation, whether it should be increase or decrease, or there was the previous increase and you need to reverse that increase, or there was a previous decrease and you will need to reverse that decrease. And the fourth scenario, the reevaluation and depreciation. So we are going to look at these scenarios with practical example, practical question and solution. So let's get started. The change in carrying amount when you conduct the reevaluation at the end of the each year, the result, whether it should be increase in the value of the carrying amount, the value of the asset, or reversing the previous increase in value, or you need to reverse previous decrease in value, or the last scenario, there would be revaluation and depreciation. It means the asset is depreciated and then you conduct the revaluation on that asset. So in case there is a increase in value, the asset value will increase and you will recognize that increase in the statement of the financial position. On the other hand, in the credit side, other comprehensive income should be the revaluation surplus under owner equity heading. So these are when the asset value increase, you recognize the asset value that increase and the asset value as a debit, and in the other side, the credit side, will be revaluation surplus with the other comprehensive income, and eventually you will transfer that to owner equity under owner equity. In case you are reversing the previous increase in value, the revaluation surplus would be debit up to the amount of that related existing amount, and then you will have this is double entry. Please bear in mind this two double entry, and profit or loss, any remaining amount shall be debited and directly to the profit or loss. And the credit side will be asset value. Here the asset value is decreased. So in the statement of financial position as reclassification and at its fair value. So in case in the third scenario, we are reversing the previous decrease in value. So asset value will increase in the statement of financial position to recognize an asset at its fair value. So on the other hand, the profit or loss will increase and the revaluation surplus will increase with the amount of previous decrease. This we are reversing the previous decrease, so the profit will go up, and the profit or loss account will go up, and with the amount of any remainings shall be credited as revaluation surplus under owner equity. The last scenario is going to be revaluation and depreciation. So in such a case, an asset was depreciated in prior years. So you depreciated your item of the property, plant, equipment in previous years, and then you are conducting the revaluation this year or the current year. In this case, there has been a surplus at the current year, so the debit side entry would be, so in the same case, in this year there has been the debit side, the entry would be, the double entry would be accumulated depreciation. We need to reverse that accumulated depreciation or decrease, and asset value will go up. On the other hand, the credit side will be revaluation surplus, other comprehensive income. So let us see this in practical scenario or a practical question. So we're gonna have example on the increase, and we're gonna have practical example or practical question reversing the previous increase, and we're gonna have this also practical question, and here also. So please, you could rely on these rules, the debit side or credit side. So if you go, this is a question. The question, this is revaluation increase. We are going to have this example here.